Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, May 11th, 2026. The S&P 500 and the Nasdaq printed fresh records. But don't confuse that with an easy, broad rally. This tape felt like a knife fight. Semiconductors and energy pushing higher, while mega-cap internet and communication names pulled like an anchor. The vibe wasn't euphoria. It was controlled aggression and rotation. On the S&P 500 heatmap, the board was split. You had bright green clustering in semiconductors, Nvidia up about 2%, MU up 6.5%, and QCOM jumping over 8%. Energy and industrials also showed real support. Think Exxon and Caterpillar. But the big red weight, communication services and the mega-cap internet complex? Google dropped about 3%, with Meta and Amazon also lower. And one more oddity. Consumer staples were unusually weak. Philip Morris was a big green exception, sitting inside a defensive sector that was mostly red. So, what does that heat map actually say about money flow? It looked like a barbell rotation. On one side, traders paid up for AI compute and memory exposure. Semiconductors stayed bid. On the other side, they chased energy. Crude jumped on renewed doubts around a US-Iran ceasefire and diplomacy. The surprise tell? Defensives. Consumer staples were getting sold on a day with geopolitical tension. What does that mean? It means this wasn't broad de-risking. It was reallocation, moving into higher torque narratives and away from crowded defensives and mega-cap internet exposure. And that sets the tension for the day. Record highs, with fractured internals. Semis were lifting the tape, while key platform names were active drags. It creates that classic dissonance, headline bullish, but intraday conviction feels shaky. Risk appetite showed up, but only in specific places where the narrative has near-term demand signals, anything carrying valuation, regulatory, or capex overhang. Especially in mega-cap internet, it got sold anyway. Now onto chatter and narrative fuel. Keep this clearly in the not confirmed as the sole driver bucket. In semis, MU strength was tied to reports around supply risk and pricing optimism, including concerns referenced around Samsung. In energy, the oil spike was framed around renewed doubts on the US-Iran ceasefire and diplomacy headlines. And for big internet, pressure in Google sat alongside ongoing regulatory overhang narratives, including DOJ remedy timelines. One more thing. Philip Morris ripped, even as staples were weak, but in our sweep, there wasn't a single confirmed same-day headline. So treat that as positioning or follow-through, not a verified catalyst. Qualcomm QCOM was one of the loudest tells on the day, up over 8%. The framing here? A continued repricing of Qualcomm as an AI, edge, and data center beneficiary. It's not just a handset story anymore. Why did it matter today? Because when Qualcomm is a standout green block, it signals traders are still willing to chase semiconductors, way beyond the usual AI pure play. Micron MU surged over 6%. The move was heavily tied to the memory rally, supply risk and pricing optimism, plus bullish sell-side framing around AI memory demand. Reports also pointed to disruption concerns over at Samsung. So, why did MU matter? Memory is the more cycle-sensitive part of AI infrastructure. A strong MU tape reads as the market leaning into sustained build-out, not just compute high. Nvidia was up about 2%, and the context matters. Semis led even while mega-cap internet names were red. Nvidia being green while Google, Meta, and Amazon sold off. That was a clean AI hardware beats AI platform divergence signal on the tape today, and it helped keep the broader AI complex feeling fully supported. Alphabet, Google dropped about 3%. And it mattered because of sheer weight. It was part of the broader mega-cap internet and communication services pressure. The backdrop, ongoing regulatory and capex overhang narratives, including DOJ remedy timeline headlines. When Google is a bright red block, it can mask otherwise decent breadth. It makes the whole session feel way heavier than the index print suggests. Exxon Mobil XOM climbed over 3.5%. Crude oil surged on renewed doubts around US-Iran ceasefire diplomacy, adding a continued geopolitical supply risk premium. The key point here? Energy became the macro hedge that actually worked today, and it competed with rather than opposed the risk on semi-trade. That's a very specific kind of rotation tape. Philip Morris PM jumped 6.5%, and it stood out because consumer staples as a sector were unusually weak. In our research sweep? Not a single confirmed same-day headline tied to the move, so we can't pin it to a specific catalyst, but as a market signal, a big PM rip while staples are red reinforces one thing. Defensive wasn't the safety trade today. Looking to the next session, the immediate swing factor is geopolitics-driven oil volatility. US-Iran ceasefire headlines can move energy, and with it, factor leadership. On the micro side, keep an eye out for any corporate updates tied to AI infrastructure demand and semiconductor supply. And on the calendar for the week of May 18th, pending home sales on Tuesday the 19th, FOMC minutes on Wednesday the 20th. Then a heavy Thursday cluster, Philly Fed, jobless claims, and flash PMIs, followed by revised University of Michigan sentiment on Friday the 22nd. No prediction here, just the likely catalyst map traders are watching. Bottom line. The market hit records, but the story was rotation and internal divergence. If semis and energy keep carrying the load, the indices can stay resilient, but the damage check remains those mega-cap internet drags. Tomorrow, it's less about the headline print and more about whether leadership broadens or narrows again. We'll be watching the same battlegrounds. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.